Market View. I'm back with Bill again this week. So obviously the story all over the news is Syria, predominantly, sort of started over the weekend, and now we're seeing developments throughout the week. It's had quite a big effect on the markets, obviously. So what are we sort of seeing in terms of...
Well, I think the interesting thing, and maybe interesting is not the right word, the concerning thing is that for the last 3 or 4 months, whether it be the Fed, whether it be the ECB, the Bank of England, especially now with the new governor, they've been talking about the recovery being, quote, data dependent. Well, as we've seen, as you said in the last week, data dependent, it's Syria, geopolitical risk. Excuse me, and we've really seen it, unfortunately, with the emerging markets, whether they be in Europe, but especially in Asia. So I think that is really what's happening right now. We're seeing a flight to quality, gold, oil, even back into the dollar, but not like you would have expected, a safe haven. But that's really what, that's what everybody's talking about now. Where are we in reference to Syria? Has the war started, that in, this, that, and the other? I think what at least has calmed the markets today. I mean, this time yesterday, David Cameron was ready to send the troops in immediately. So was Barack Obama. Now I think that we're waiting for, I guess, a report from the United Nations, and even the Arab League, which was, let's attack Syria. Even the Arab League is saying, well, let's keep a cool head.
Yeah, I think it's to investigate exactly where these attacks, exactly what happened, being sure before going. And you mentioned oil there, and that's flight, safety. And we've seen an effect on oil, and then it particularly affecting sort of India, and we've seen their government intervene. What sort of measures are they taking? Do you see this? Obviously, emerging markets are very, very vulnerable right now. What sort of things do you think we're going to start?
Well, I think, and unfortunately, I'm going to have to go back before you were born, okay? In the early 1980s, okay, in the States, we had the first emerging market crisis with Argentina, where we had to do what they call Brady bonds. And the U.S. then had the basic guaranteed bonds from Argentina and Brazil, etc. Now, one of the things to look at is, when that first occurred, emerging markets was basically only 15% of global GDP. China was still living in the dark ages. We had the Cold War, we had this, that, and the other. Then in 1998, we had a second crisis, okay? First the Thai baht, then the Russian ruble, and then a slight problem with LTCM, okay? The Fed then basically stopped raising rates, and Greenspan basically dropped rates for 3 of the next 4 meetings. And at that time, global emerging markets were 35% of global GDP. Now we're talking about it's 50% of global GDP. So they're major players in here. And one of the things that we're seeing, the countries that are getting hit and hit hard are basically the major countries that have huge outstanding current account deficits. And remember, the one thing we always forget is this is a global economy. I mean, remember, probably 90% of Malaysia is owned by the rest of the world, and it goes all the way down into the low 70s. So the simple fact is, your pension fund with XYZ insurance company may own Malaysian bonds or emerging markets, this, that, and the other. And if you see, in reference to some of the funds, the classic, of course, is the Fidelity Special China Fund, okay, which at one point was up to 125. It's now down either low 90s or high 80s. And that's China, who's still showing growth of maybe 7.5%. And so I think that's one of the things that we have to look at. This is now a global situation, okay? So something's happening in India, something's happening and again, the biggest problem with this is India is affecting us, but just think of the effect it's having on the local population.
Yeah. Do you think they're going to be able to support their own economies? Obviously, they're trying to support.
Yeah, I mean, they will. But one of the things that we're talking about raising rates with Brazil. We're talking about intervention, okay, with Turkey and India, and also Indonesia last night setting up a major swap line with the Bank of Japan. These are positive steps, but they're almost like putting a Band-Aid on a major injury. And this is what has to be effective. And I said, then maybe it goes back to, we can all say, well, it's really already started, like in May, when we already always knew that there was going to be an end date for quantitative easing, okay? The Fed then started giving us Wake up, boys, we're getting closer and closer. Now, we've seen what kind of effect that's had on the dollar. We've seen what kind of effect it's had on interest rates in the States and now global interest rates. And I think one of the things that I know the Federal Reserve is the U.S. Central Bank, and it's their job, again, to protect, aid, support, inflation and growth in the United States. But one thing, and I think we shouldn't ever lose sight of this. Remember, the dollar is the almighty dollar. Everybody owns dollars, okay? And so because of that, the Fed has to really look. They have to, quote, temper their tape. They have to look at what they do, how it affects the whole world, not just Washington, Pittsburgh, Detroit, Dallas, etc., etc. And I think right now, they didn't do it in 80. They did a better job in 98. I think in 13 and 14, they're going to have to do a fantastic job looking at the global picture and maybe tapering.
Yeah, so do you think it will affect the decision, particularly if we see further vulnerabilities within, like India and Brazil? Do you think?
I think it has to, okay? Because we are seeing an improvement in the U.S. economy. Yes. I'm concerned about the housing market because in the past, 6 weeks, we've seen mortgage rates in the States go from 335 to 475. As we saw, with the Case-Shiller, house prices are going up. So if your house price is going up and you're looking to buy, and your mortgage is going to go up, your petrol prices are going to go up, maybe you say, well, maybe I wait till after I finish paying off the school fees, which all the kids going back to school now. So that could slow it down. We got a positive, jobless claims number. My feeling for next Friday's non-farm payroll is 190,000. Okay. So it's improving, but it's also like the captain of the Titanic. What iceberg? You see, this has to be looked at from a global perspective, and hopefully the Fed won't make the mistake as they did in 98, and more so in 80 and 98, in thinking too domestic.
And another event this week was obviously Carney, who's up in Nottingham giving his first speech since the minutes, and he tried to reiterate his point, and a very dovish speech again, but we still saw the markets react, in the opposite direction.
Well, again, it was quite interesting because what was his speech at 1:45 our time yesterday? Well, if you looked about an hour or so before that, we saw sterling collapse to 154.27. Okay, now it took a while, but the rumor was several people supposedly had leaked the speech, and of course it was wrong. But the comment was it was going to be uber dovish rather than just dovish. So all of a sudden we went 154.27 back to 155 plus, and I think to finish the speech we were up 100 pips from where it was. But again, I'm going to show my age here, baby. Mr. Carney now for the second time since July, he's talking the talk, but the market said, can he walk the walk? Okay, because the market both before and after the speech did not change the perception that interest rates will start rising in mid-2015.
I perceived it as a very dovish speech. What do you think he needs to say to get it? I don't think he could really say much more. He needs to make it clear.
Well, I think maybe he's got to go to Jake Bugg or whatever his name is. Maybe Jake will write a song for him with this. I guess I'm showing my age. I never heard of Jake Bugg. I had to come on to Google or whatever it was. He did leave the situation open that they have a lot more tools in their toolbox. But one of the things, again, we're looking at, okay, we had Charlie Bean and Jackson Hole over the weekend start saying, well, why don't they sort of believe us? But he also feels that maybe we need not quantitative easing, but something else in the toolbox. And we had Martin Wheel come out last week, basically saying we need another $25 billion in quantitative easing. And if we can remember back to 2011, he voted 7 times that year to increase interest rates. So we see a rather dramatic change. And the fact is, Mark Carney can basically say, but is there a little dissension in the locker room? He's not Alex Ferguson, right? So, if somebody upsets him, I can see Mark Carney throwing his boot. But I think that's the thing. We hear him talking, but we don't believe him yet, okay?
I'm just going to touch, we've obviously got Bank of England and ECB next week. Have you got any thoughts of what we might see? Anything different from Draghi? I think it's going to be...
Excuse me. No, traditionally, I know that this will be the September meeting, but up until, I guess, the last couple of years, the August meeting, okay, of the ECB, with both the first two governors, was a phone-in. Because Europe is always on holiday in August. Now, I don't see anything at all. And can you see, will it be distorted if this situation in Syria is still, I'm sure you'll say the same thing, we are ready to do anything, but even within the ECB. Now, if you saw last week, you had Austrian Central Bank, Novotny, up, no more interest rate cuts, and then, Hans Weber from the Bundesbank saying the same thing, and then within the last 24 hours, yesterday, the day before, we had Kurz and then Asmussen say, well, rates will probably stay lower for longer. I still feel we probably need one more rate cut from the European Central Bank.
Do you think
because
we'll get that this year?
we're running out of months, aren't we?
Yeah.
No, I don't think so. But also, you are now starting to see the euro, especially the euro dollar, is off like another 100 pips today. And one of the things, if you look at dollar index futures, okay? Dollar index futures for December are applying a 5% depreciation of the euro against the dollar. So, that would be positive because at least you can't have a strong currency if you're going to have an export-led economy. Hence the reason, I still feel that sterling at 155 against the dollar is much too high. It should be 150 or lower. So, then we're going to have to mix the geopolitical situation with the true academic situation. And next Friday's non-farm payroll will be an interesting number. I'm targeting plus 190. The 12-month moving average is 194, so we're getting up near the top range. Maybe the rate still comes in. I haven't looked at the numbers that much, but I'm still looking at the 7.4 rate.
Yeah, so it's looking pretty positive.
It is.
The US,
but you see, one of the things with the US number last month, there were really no more new jobs created. The 0.2% was the OAPs. Decided that they've had enough stacking shelves at Walmart and I'll just go play golf in Florida. Now we can start seeing the same evolution here. So we could see a dramatic drop from the 7.8 to the 7% level that they're talking about. Not as a starting point, but as a level where people just, do they just get out of the workforce altogether?
Currently focused on it would be this many jobs
Yes.
created. I think trying to, explain how it's going to take such a long time, but realistically, it's not about how many jobs necessarily will be created.
And I mean, if you look at the data over the last 3 years, even as bad as it's been, I think we've created like 1.5 million. And so we've seen a rather sizable drop in the unemployment rate. But the point being is, we may have a drop in the rate, but we have an increase in wages. And I mean, even over here, okay, house prices going up. And what, house prices up like 20% in some parts of the country, mostly here in London. But I mean, even in some of the areas where I live, in Wiltshire, in West of us, we're seeing 8, 9, 10% house appreciation. Mortgage rates, unfortunately, have not gone up, but expect petrol to go up another 2 or 3p by the end of next week. As I say, parents are so glad. They're out all out buying the school clothes today, getting ready to send all the kids back next week. Then, in a couple of weeks, we'll start getting hello, this is the bursar at XYZ primary school. Could you please send a check?
Yeah. Oh, brilliant. Okay, well, that's an interesting stuff to watch out for next week.
Brilliant.
Thank you very much.
Thank you.